What up, guys? Comment down below if you like this new setup, right? It's more lively. I get to stand, I get to move, I get to really engage with you guys. Something tells me that you guys want to learn about investing. If you insist, I'll go over the top 6 ways that you can invest your money in order of increasing risk. Quick story, when I was in elementary school, they made us open these savings accounts, right, with a local bank. And so I took all my money from my piggy bank, which was about like 120 bucks, and I put it in the savings account. And then a year later, the bank sends me this statement saying, how much interest I've earned. And it was like a whopping 72 cents, which was like, 0.6%, right? And so I was like, okay, forget a 9 to 5. I'm about to drop out of school right now because I'm Warren Buffett out here with my investments, right? But then I woke up and found out that 0.6% isn't the best return on your investment. So, moral of the story is savings accounts aren't the most lucrative investment, but with the advancements in technology, we now have online savings accounts that some banks are offering that offer up to 1.5% interest per year. Now, these bad boys are the OGs of investments, right? They have very low risk because the US government is almost surely going to pay you back. And I know what you're thinking, but let's not get political here. So basically, you are loaning money to the government and in return receiving interest. Now with a savings bond, you're going to receive your initial investment and your interest back at the end of that loan term. But with a treasury bond, you're going to receive your interest payments every year and your initial investment back at the end of the term. So the only difference is basically when you're going to receive your interest payments. With a savings bond, you're going to receive your interest at the end of the term, and with a treasury bond, you're going to receive your interest throughout the term. Now this one is pretty new and pretty lit, alright? Peer-to-peer lending is a market where the lenders and borrowers are average people like you and I. You can literally loan someone from down the block your money and receive that back plus interest. You can invest in as many loans as you want, and it's actually better to invest in more loans just in case one of your borrowers happens to be a broken vending machine or like R. Kelly or something. But in terms of profit, this is a high-risk, high-reward situation where you will receive more interest from people who have lower credit, but this also means that they're more likely to default. Real estate is actually the triple OG of investing. Remember when people were buying these state-sized plots of land? Like I'm talking Louisiana Purchase type things. This was how you could really turn your $100 into $1,000. Today, it's a bit of a different dynamic, but there's still opportunities for us to invest in real estate. You can buy a rundown or foreclosed home, fix it up a bit, and then sell it for higher than you bought it. You can buy a house or building and rent it out to tenants, and in this case, the property value can rise in addition to receiving rental payments monthly. And lastly, the newest way we can invest in real estate is through sites like fundrise.com. Basically, instead of me going out and trying to find $500,000 to go invest in some rental property, Fundrise gathers $500,000 from investors like you and I and invests in those properties for us, and then we all collectively share the profits. Mutual funds, index funds, and robo-advisors all do subtly different things, but revolve around the central theme of making stock market investing a little less complex and time-consuming for you. Index funds represent a group of stocks, and essentially what you do when you invest in an index fund is say, okay, in the S&P 500, I don't want to figure out which companies are the best and do all these valuations and watch CNBC every day. So I'm just going to invest in all the companies in the S&P 500 and then hope that over time they'll increase in value. Mutual funds are pools of money that are usually managed by someone, and they differ by strategy or theme. So you kind of have to shop around and see which mutual fund is in line with your investment strategy. And if that's still too much for you, robo-advisors like Acorn, which you probably have heard of, will invest in those mutual and index funds for you. So literally all you have to do is deposit your money in the account and tell them how much risk you're willing to take, and that's it. If that's still too much for you, then just give all your money away to the state lottery that you'll never win. I could go on for days about stocks. The stock market allows regular individuals like you and I to invest in ownership of public companies like Apple or Facebook. Side note, Remember when Facebook went public? I thought that meant that all my to be honest posts and messages about my crush were gonna just get sent out to everyone. But it just meant that their ownership was being offered to the public market. Noob move. When you invest in a company, you are claiming a share of its future profits. So if you think a company is going to be profitable in the future, you invest in it. And if not, you don't. Future profits can come in the form of an increase in the share price, so the value of your stock goes up, or a dividend paid by the company. A dividend is basically the company saying, okay, we have this extra cash sitting around. Shout out to our investors, because you guys are the real MVP. You keep us going. So we'll just give you some cash. Crypto. A cryptocurrency is a digital currency that uses blockchain technology to exchange values in the form of digital coins that operate independently of a central bank. This is a very new space and with very high risk attached to it because there's no SEC that is looking out for Ponzi schemes and scams just like they would in the stock market. But it's similar to the stock market in that you can buy an asset that will go up or down in value. Cryptocurrencies are usually valued by the usage of the currency and more so the hype of the currency. And these two things are unquantifiable. Like I can't raise hype to the power of E and then divide it by public sentiment to get a valuation. So even though Bitcoin's price was saying more hype, more money not too long ago, the world is still trying to define this new technology. But don't get me wrong, there is still money to be made, but with very high risk associated with it. This was a lot, I know. So comment down below if there's any misunderstandings and I'll help iron those out. But also keep in mind that I'll be doing videos on each one of the investment opportunities that I've discussed in more detail. Also, if you're ready to invest right away, check the description for links to all of the mediums that I've discussed. Ultimately, this video should have given you a better understanding of investing based on your own goals and risk tolerance. Whether it's a risk-free savings account or the wild west of cryptocurrency, your investments should allow you to sleep comfortably at night. So after watching this video a few times, take some time to define your own goals and risk tolerance and comment down below the top 2 ways that you want to invest moving forward. So that's it for now. Remember to like, comment, and subscribe. Share this with a friend. Let them know that we're giving away an Amazon gift card at 150 subscribers. And that's about it. Brokers and mentality, y'all.